80 minutes. That's all it took. 80 minutes for nearly $1 trillion to disappear from global markets. Not over a week, not over a day, and barely more than an hour. Silver didn't slowly slide, it collapsed. Screens turned red, trading desks froze, stops were triggered in waves. This was not normal volatility. This was a forced liquidation event, a cascade, a financial stampede where no one wanted to be the last person holding the bag. Silver prices dropped so fast that traders couldn't react manually. Algorithms took over, margin calls started hitting accounts. Mining stocks were getting crushed even harder than the metal itself. But here's the real question. Who got destroyed in those 80 minutes? Retail traders chasing headlines, leveraged hedge funds, or someone bigger who miscalculated risk? Because when $1 trillion vanishes that fast, it's not just a bad day, it's a structural message. And most people completely missed it. So what exactly happened? In simple terms, silver was heavily crowded. Too many traders were on the same side. Prices were stretched, leverage was high. And when the first wave of selling hit, it triggered a chain reaction that spiraled out of control. This wasn't random. It wasn't magic. It was positioning, liquidity, and modern algorithmic trading colliding at the worst possible moment. Here on the quiet markets, we don't chase hype. We break down structure. And in this video, we're going to expose the real trigger behind the crash, the hidden mechanics most people never see, and what it means going forward. If you care about understanding how money actually moves, hit like and subscribe right now, because the next 80-minute event won't send a warning first. To understand the crash, you have to look at what happened before it. Silver had been rallying aggressively. Prices were climbing week after week. Headlines were getting louder. Analysts were raising targets. The narrative was simple. Supply tight, demand strong, breakout confirmed. That kind of momentum attracts attention fast. Retail traders started piling in. Social media was full of screenshots, bold predictions, and claims that silver was just getting started. When price keeps moving up, confidence turns into certainty. And certainty is dangerous in markets. ETF inflows were rising. Futures positioning showed funds increasing long exposure. Everyone wanted upside. Very few were thinking about downside. That's how crowded trades are built. When too many participants lean in one direction, the market becomes fragile. It looks strong on the surface, but underneath it's unstable. Because if price starts moving the other way, all those positions become fuel for a reversal. At the same time, macro pressure was quietly building. Bond yields were rising. That matters. When yields go up, holding a non-yielding asset like silver becomes less attractive. The opportunity cost increases. The dollar was also strengthening. A stronger dollar typically puts pressure on commodities priced in dollars. So while retail enthusiasm was growing, the macro environment was not fully supportive. This is where most traders make a mistake. They focus only on price action and ignore positioning in macro context. Silver wasn't just going up, it was becoming crowded. And silver is not a calm asset. Structurally, it's smaller than gold. It has lower liquidity relative to other major markets. That means when large orders hit, price moves aggressively. It's also tied to both monetary demand and industrial demand. That dual identity makes it sensitive to shifts in inflation expectations, growth outlook, and currency strength at the same time. So by the time the crash started, silver wasn't just elevated. It was extended, crowded, and sitting in a macro environment that could easily trigger pressure. And when you combine leverage with crowding in a volatile asset, you don't need a massive catalyst. You just need a spark. The trading day started quietly enough. Futures opened a little weak, nothing dramatic at first glance. But behind the scenes, the positioning was already stretched. Every big player knew that the market was fragile. One wrong move could trigger a cascade, and that's exactly what happened. Then the first large sell orders hit. Not small trades, but multi-thousand contract blocks. They slammed into the market like a wave. Prices dipped slightly at first, but this is where modern markets get dangerous. Algorithms were monitoring levels, and certain technical thresholds were being watched by hundreds of automated systems. When a key support level broke, it wasn't just a number on the screen, it was a trigger. Algorithms kicked in, selling automatically, feeding off each other. Every dip created new selling pressure, and human traders suddenly found themselves chasing a falling market they couldn't control. Stop losses started cascading. Accounts that had been long for weeks, even months, were liquidated automatically. Positions that seemed safe evaporated in seconds. The speed was astonishing. Traders who thought they had time to react had no chance. Margin calls followed immediately. Those using leverage were forced to close positions, adding even more pressure. The market's thin liquidity meant that every forced sale pushed prices lower, creating a feedback loop that seemed unstoppable. Mining stocks didn't escape the carnage. Even companies producing physical silver got hammered as investors dumped related equities. Losses amplified beyond the commodity itself, spreading across ETFs and derivatives. By now, panic was spreading. The real danger revealed itself, a liquidity vacuum. Buyers had disappeared. No one wanted to step in while the market was falling so aggressively. Without demand to balance the selling, prices plummeted faster than anyone could calculate. It was the perfect storm: crowded trades, leverage, algorithmic selling, and evaporating liquidity, all combining in one brutal collapse. 80 minutes later, billions of dollars had vanished. Some traders watched helplessly. Some survived by luck or hedging. But the lesson was clear. In modern markets, speed, positioning, and automation can overwhelm even the most confident participants. When we say $1 trillion was wiped out, it's not an exaggeration. This number isn't just silver futures. It includes ETFs tracking silver, mining stocks, and related derivatives across global markets. Every position, every contract, every share affected by this collapse adds up quickly. Think of it like a row of dominoes. Each falling piece doesn't just affect itself, it pushes the next one, and the effect multiplies. In today's markets, with trillions of dollars in leverage and electronic trading, one big move can ripple through multiple layers almost instantly. Market capitalization doesn't evaporate slowly anymore. It disappears in minutes. When leveraged positions are liquidated, ETFs rebalance, and mining stocks are sold aggressively, billions vanish before most people even check their screens. That's why headlines scream $1 trillion lost in just 80 minutes. It's real, measurable, and terrifying if you weren't prepared. And it's not just a number. It's a reflection of how modern markets function. Small sparks, when combined with leverage, crowded trades, and thin liquidity, can create massive destruction in record time. For the average investor watching at home, these numbers might seem abstract. But for anyone involved in silver, the lesson is simple. Speed and positioning matter more than intuition, and ignoring them can be catastrophic. The hardest hit? Leveraged retail traders. People who bought near the highs, excited by social media hype, thought silver could only go up. Many had borrowed money to increase their exposure. When prices started falling, their positions were liquidated automatically. Accounts that seemed secure disappeared in minutes. Panic spread fast. People were watching savings vanish almost in real time. Overexposed hedge funds weren't safe either. Some had large, concentrated long positions in silver, expecting a continued rally. When the market turned, they were forced to sell aggressively to meet margin calls. Even professional traders with teams and analytics couldn't outrun the speed of algorithmic selling and cascading stops. Margin liquidation was the silent killer. Brokers automatically closed positions once thresholds were breached. It doesn't matter if you believed in silver's fundamentals. When the system triggers a margin call, theory means nothing. Cash is demanded, and if you can't meet it, your position is sold at market price. That's how volatility becomes devastating. Institutions that survived better had an edge. They didn't rely solely on momentum. They hedged exposure, diversified positions, and sized their trades to withstand sudden shocks. Their risk management systems were designed to handle chaos. While retail and over-leveraged players were getting crushed, these players often profited, or at least stayed afloat. The lesson is brutal. In markets like silver, knowledge alone isn't enough. Position size, leverage, and hedging can mean the difference between wiping out and surviving. And 80 minutes proved just how unforgiving modern trading can be. After a crash like this, the first reaction you hear online is always, it was manipulation. Big banks, hedge funds, or shadowy players must have engineered it, right? While markets can be influenced, the reality is rarely a grand conspiracy. Most of the time, it's about structure, not villains. This was a classic crowded trade unwind. When too many traders pile into the same long positions, the market becomes fragile. It doesn't take a massive external shock to topple it. A small trigger, rising yields, a stronger dollar, or even a rumor, can start a chain reaction that snowballs quickly. Silver has a history of this. In 1980, after the famous Hunt brothers run, silver collapsed violently once positions were over-leveraged. In 2011, after prices hit nearly $50 an ounce, a sudden unwind wiped out large positions almost overnight. The patterns are strikingly similar: euphoria, crowding, leverage, then rapid liquidation. What makes today different is speed. Algorithms, real-time margin calls, and thin liquidity amplify the effect. When stops cascade and selling accelerates, it looks dramatic, but underneath, it's still just positioning and liquidity interacting. No secret puppeteer required. The key takeaway? Blaming manipulation ignores the real drivers. It was crowded positions, leveraging, and fragile liquidity that created the bloodbath. That's the lesson for traders, investors, and anyone watching silver markets. Understanding structure matters more than chasing conspiracies. The 80-minute silver collapse was painful, but it also revealed a deeper truth: the fragility of modern markets. On the surface, liquidity looks abundant. Screens show volume, bids, and offers. But when panic hits, that liquidity can vanish in seconds. What seems stable disappears almost instantly. Algorithms dominate trading today. They're designed to react faster than any human can, adjusting positions automatically when certain thresholds are hit. In calm markets, this is helpful. In a sudden crash, it becomes a force multiplier, amplifying selling and accelerating declines before anyone can intervene. This creates what I call a liquidity illusion. Traders think the market is deep and can absorb large orders, but when everyone moves at once, bids evaporate. Prices fall steeply to find someone willing to buy. That's exactly what happened during the silver bloodbath. The speed of financial contagion is astonishing. Once selling spreads in one market, it affects correlated assets. Mining stocks, ETFs, even related commodities, all get caught in the ripple. It shows how interconnected today's financial system is and how quickly risk can propagate. And this matters far beyond silver. Any crowded trade, any leveraged position in a volatile asset can trigger similar events. The lesson is clear. Understanding market structure, liquidity, and systemic risk isn't optional, it's survival. Investors ignoring this are walking blind into the next 80-minute crisis. After such a dramatic collapse, many traders are asking, is this just a short-term shakeout, or is it the beginning of a longer trend? In the short term, oversold conditions often attract buyers looking for a quick rebound. Prices can bounce back sharply, especially when panic has forced weak hands out of the market. But don't mistake a bounce for stability. Macro risks are still looming. The dollar is strong, bond yields are rising, inflation trends are uncertain. Each of these factors puts pressure on non-yielding assets like silver. Even if retail enthusiasm returns, macro forces could cap upside. Industrial demand also plays a role. Silver isn't just an investment metal, it's used in electronics, solar panels, and other industries. If global growth slows, industrial demand could weaken, keeping additional pressure on prices. Conversely, a pickup in industrial use could support silver's recovery over time. Looking further out, the crash could represent structural repricing. Crowded trades have been cleared, leverage reduced, and market participants are more cautious. That means the silver market may settle at new equilibrium levels, lower than the recent highs, but potentially more sustainable in the long term. For investors and traders, the lesson is clear. Short-term volatility is unavoidable, but understanding the interplay of macro factors, industrial demand, and structural positioning is key to navigating what comes next. If there's one thing the 80-minute silver crash teaches, it's this. Leverage is a double-edged sword. It can amplify gains, but when things turn, it destroys accounts instantly. Discipline isn't optional, it's survival. Know your limits and never risk more than you can afford to lose. Position sizing is just as important. Many traders got wiped out because they put too much capital into a single trade or crowded market. Small calculated positions survive chaos. Big reckless positions don't. Simple math beats hope every time. Emotional control matters more than skill sometimes. Watching your positions fall hundreds or thousands of dollars in minutes triggers panic. The traders who survived didn't act on emotion. They stuck to their plan, hedged when necessary, and didn't chase losses. You need a clear strategy. If you're trading with no plan, it's gambling, plain and simple. Strategy includes entry, exit, risk parameters, and contingency planning. Without it, luck decides your fate. Finally, remember, in markets like silver, survival comes before profit. You can always make money later. If your account is wiped out, nothing else matters. 80 minutes proved it. Controlling risk is more important than chasing glory. Now the big question, was this 80-minute bloodbath just a temporary flush or the start of a major structural shift in silver markets? We want to hear your take. Drop a comment below with your thoughts. Are we seeing a short-term shakeout or is something bigger unfolding? If you found this breakdown valuable, share this video with someone who thinks markets only go up. The next 80-minute event could happen anywhere, and being informed is the only way to stay ahead. At the Quiet Markets, we don't chase hype. We analyze structure, liquidity, and positioning so you understand what really moves markets. Subscribe if you haven't yet, and stay tuned for deep dives like this one, because knowledge is the real edge in trading.